morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Surbi Upadhyay and Pavitra Parekh. As always, good morning, girls. What we want today is a follow-on rally, right? Yesterday was a good session for our markets. The benchmark indices ended with a gain of 1%, but today we are flat. The good part is the Nifty opened below that 17,900 mark. There was a dip in the first 15 minutes of trade, and since then there has been some buying interest. So we are flat right now, but we're off about 65 points from the day's low. The mid-cap and the small-cap index, these two indices were under pressure for the last two trading sessions, but they're outperforming relatively. So the mid-cap index is up close to about 0.3%. Once again, it's the large cap and select large caps which are contributing to the gains today. So Reliance Industries is firing strong for the second day in a row. Apollo Hospitals, prima facie, the numbers look muted. Margins were under pressure, but the stock is actually the top Nifty gainer now, 3.5% higher on that. Eicher Motors slipped yesterday because margins declined for the second consecutive quarter, but the street has now taken it in its stride, and Eicher Motors too has rallied close to about 3.5%. And Adani Group stocks, Enterprises and ports, both in the Nifty, are up and about. In fact, make it to the top 5 or 6 Nifty gainers today. So flat on the benchmark indices, but we're going to take that green in the broader markets finally, right?
Yeah, Reema, I completely take your point. No, we wanted to see that big follow-on day. The question is whether we get what we want. And I guess in the context of what global markets have been doing, this is not that bad, because if you look at the Asian screens, Asian markets have been down between 1 and 1.5%. The Kospi, the Hang Seng, a lot of those indices are trending lower, and that's because of that inflation number that we got in the US overnight. So that continues to be a little bit of a worry spot. So overall markets are kind of taking it easy around the world as the inflation, the bond conversation, the US 10-year has been the one in focus. But the Nifty for the time being absolutely at the flat line, very indecisive, but we've recovered from the lows of the day. And Pavitra, as Reema also said, I think that's, you have some very interesting movers, like look at Torrent Power in the market today. Some of these interesting result reactions, that's where the buyers are going. It's not about the headline index, at least as of now. Oh,
absolutely. I mean, there is a lot of action going on beneath the surface, right? So you mentioned Torrent, but you have something like a Borosil, you have Bharat Forge, all of these seeing, outsized moves based on their results. In terms of sectoral indices, you're seeing the metals pack do well today, and real estate. Real estate, of course, was down sharply yesterday, but those sectors really coming back. So some of the larger names will be up for you. Tata Steel, JSW, JSPL, these are some of the relatively better performers. A lot happening in the real estate space. So take a look at Prestige Estates. That one is up sharply. You have Indiabulls Real Estate, Godrej Properties. There you have it. Indiabulls Real Estate is up almost 5% in this pretty subdued looking market right now. So that's what's happening over here. Reliance has been a big supporter over the past few days. For the week, it is up around 3.7%. So that seems to have really come back, and that is helping. On the downside, there are a lot of pharma names. In addition to the large ones like Sun, Cipla, DRL, there are a lot of the smaller names as well, which are under sharp pressure. So something like a Glenmark Life, you have Supriya Life Sciences, which is seeing a sharp cut coming through, even something like a Shilpa Medicare. So there is a lot of pressure there, and we have been talking about, pharma earnings really not being quite disappointing. So that space definitely continues to be in focus. So that's what's going on with the markets. But let me run you through everything that we have lined up for you over the next 1 hour today. Key indices trade flat while the mid caps outperform today. We'll discuss the way forward for the market with Devang Mehta of Centrum Wealth Management. From the earnings corner, the managements of MapmyIndia and HEG will be joining us to discuss their Q3 numbers. And staying with earnings, the focus will be on packaging companies because a whole host of stocks are under pressure post their quarterly results. A quick roundup coming up later on the show. So all of this and lots more lined up for you on Trading Hour over the next 60 minutes.
Let's kickstart the show with the first corporate, and that is MapmyIndia. Now, this is a company which is a digital maps provider, but unlike Google Maps, which is a B2C player, we use it on our phones. MapmyIndia is predominantly B2B. Enterprises use it. So many of your, the Swiggies and Zomatos, I'm not naming their exact lines, but they would use it to reach your location to deliver your parcel. Now, we're talking about their Q3 numbers. Now, revenues are very strong on a year-on-year basis, but on a quarter-on-quarter basis, it has dropped by 11%. EBITDA margin too was higher this quarter, aided by lower marketing expenses. Rohan Verma, the CEO and Executive Director of MapmyIndia, is now with us on the show to discuss numbers and the way forward. Rohan, morning, and thanks for joining in. This is Reema here. First, could you explain that quarter-on-quarter drop in revenues?
Hi, Reema. Thanks for having me on your show. Q1 and Q3 seasonally typically are lower for MapmyIndia, given the sort of cycle. So I think it's just a reflection of that. Year to date, year on year is the best metric to measure MapmyIndia's performance. And on that, as you can see, it's doing quite well. And even year on year for the quarter, it's done quite well.
What about the consumer tech and digital enterprises? That's 40% of your revenues. And here you would cater to a lot of startups. And startups have been under pressure. Funding is dried up for them. Any customers of yours, any clients which have shut down or curtailed their operations, they've reduced the kind of work that they were giving from you, because you also operate on a model where you charge per usage, on a charge per use and not a flat model. So could you tell us if any clients are under stress or any signs of slowdown?
If I look at it from a portfolio point of view, Rima, the number of use cases that we have, the number of customers that we have on the CNE side is quite diversified. And, some of the larger players like Amazon, Flipkart, they're all doing quite well. And they are part of our portfolio of customers. I'm sure there are small customers here and there who are suffering due to these funding crunches. And we have seen a few small, health tech like startups, etc., who have kind of, gone by the wayside. But overall, I think very, very nice to see, companies which are on strong fundamentals do quite well. And beyond the consumer tech, the enterprise sector, be it the traditional businesses like FMCG, like retail, like infrastructure companies, and even the public sector under the government, which all fall under CNE sector, are doing quite well. So, it's actually quite a good time for us that more use cases and more usage of our products and solutions are happening.
Rohan, if I look at your revenue breakup, auto contributed about 40 odd crores, and this consumer tech and enterprise, this contributed a little over 27 crores. Given what you just described, as you're looking at the next financial year now, tell us how both of these will move ahead, and also a little bit about the margin profile on both sides. Where will you be making better margins in FY24?
Sure. So A&M versus CNE both have very similar margin profiles, because essentially we license or provide subscriptions to our maps, our APIs, and our software. So what we call PaaS, platform as a service, maps as a service, and software as a service. So in terms of margin profiles, both are similar. I think if you look at our track record and even this quarter, EBITDA margins are in the 35 to 45% range. I think year to date we are at about 42.5%, and PAT margins are in the 30 to 35% range. I think year to date we might be 32, 33%. And really the contribution also is roughly split half and half. There are different growth drivers for A&M for us, whether it's new vehicles which are adopting more and more connected vehicle technology, or existing vehicles on the road or fleets on the road which need to digitize for improving logistics efficiency. So that's A&M. And CNE really, as more and more consumer apps get used by consumers, or more and more enterprises are trying to digitally transform, the value and usage of maps and geospatial technology, and even now drones, which is a sector that we are going deep into, is only expanding.
Just a very quick question on auto. Help us understand how this huge move on EVs, I mean, every auto company worth its salt has, massive plans and launches lined up. To what extent do you see that sort of, benefiting your business? Can there be a marked improvement in the auto business in FY24 because of this?
Yeah, we're really benefiting from this move towards EV, because when it comes to EVs, range anxiety is quite a question on people's mind, and navigation, which is based on informing you whether you'll be able to reach your destination with battery in hand, or what is the most battery efficient route you can take to your destination, as well as what is the health and SOC and predictive maintenance of the batteries or the electric powertrain based on the telematics we provide, are all becoming quite important, or charge station locations and being able to reserve and book charge stations. These are all part of our suite of N-case navigation-enabled, connected, ADAS, shared and electric solutions. So, and you've seen a lot of new EV OEMs sign up with us. Even just this past quarter, one of the larger foreign entrants in the EV four-wheeler space has signed up with us. And on the two-wheeler side, bunch of EV two-wheeler startups have signed up with us. So we are set to benefit from this move towards EV, because EVs by definition need more technology, and that's what Encase from MapmyIndia provides.
Okay, Rohan, then would you give us some sense on what the entire order book is looking like? I mean, the last time we spoke to you, it was around 700 crores. You are saying that a lot of these EV players have come on board and have signed up with you. Could you give us some sense of what it's looked like? How much has it picked up?
Yeah, the momentum is strong on new order wins. I think we talked about in Q3 wins across automotive, logistics, consumer tech, and enterprise and private and public sector with a lot of different use cases. We started the year with 699 crores as an order book, and we'll declare the open order book at the end of Q4. It's an annual figure, and as you can imagine, Q4 is where a lot of orders get bunched up. But momentum so far is very good. We're very pleased with progress so far, and just 3 more months and we'll declare the annual new order bookings and open order book.
Okay, we will wait for that till you declare the full order book. But just one final question on the margins. You were mentioning that 9 months is up. I mean, it's currently at around 42.5. This is higher than what you have been doing of 35 to 40. So is this going to be the new normal? Can we expect above 40% kind of margins going forward?
Actually, I think our guidance is, or just generally the way that we want to structure our business is, we are lucky that we are a digital products and platforms company with high kind of contribution margins, EBITDA margins, PAT margins. And so the trade-off between profitability and growth is not a zero sum. We want to calibrate our revenue growth in that 30-40% range while maintaining these EBITDAs and PAT margins holistically for the whole company in the 35 to 45 EBITDA and 30 to 35 PAT. So overall, this is a pretty strong kind of financial picture we would like to draw for ourselves. And so we leverage the growth that we see in margins to calibrate our marketing expenses, which has a knock-on effect on future growth of the company. So I think we'd like to stay in this range, and that can only mean stronger future medium-term growth for the company.
You're saying your margin guidance is now 35 to 45%? That's the range?
In EBITDA, yes. And in PAT, it's 30.
Okay. Last time you told us 35 to 40%, so you are increasing the upper end of the margin guidance.
I mean, ideally, I'd like to stay conservative, but as you see, the numbers are 42.5% right now. So we'd like to stay conservative because we want to maintain the ability to invest in future growth.
Rohan, we'll leave it at that. Thank you very much for joining in. That's CE Info, known as MapmyIndia. And you were just talking about electric vehicles, and here the opportunity is battery efficient route planning. You also want to know where is the closest next charging station. You want to calculate the range before you hit the next charging station. In e-commerce and food delivery, it's last mile delivery to reach your exact hotel. In healthcare and pharma, it's the GPS tracking of ambulances. In logistics, it's fleet and asset tracking, and of course route optimization. In the telecom space, you're using it for optic fiber mapping. So the enterprise use cases are so many for a company like MapmyIndia, and it's only expanding because the company is now saying maps for two-wheelers are now being offered, and that's also perhaps a potential opportunity for the company. We'll get into a break. On the other side, we'll discuss commodities. Manisha Gupta joins us next.
Welcome back. You're with us on Trading Hour. Let's get to the commodity markets now. Manisha Gupta joining in as always, and today she's focusing on crude oil. Manisha, morning. Tell us more.
Well, thank you for that. We have seen 2% of decline in the crude oil prices in the overnight markets there, and from a 3-week highs of $87 a barrel, we have seen a very sharp cut come in for the prices for last couple of sessions. Now, well, 3 things really that have led to the crude prices coming off. One is that the U.S. crude inventories have risen for an 8th straight week, and API suggests this rise at 10.6 million barrels. Then U.S. also says that after releasing 180 million barrels in the previous year, they are looking to release another 26 million barrels from the strategic petroleum reserve. that will happen in this quarter itself. And then EIA also reported, suggesting that it's going to be a record output in the month of March from the shale basin in US. So higher production, higher inventories, and the demand not matching up is what's weighing onto the crude prices. But the OPEC monthly report that came in yesterday has been slightly supportive. It says that the 2023 demand estimates has now been revised on the higher side to nearly 2.32 million barrels per day. That equals to nearly 101.87 million barrel per day of crude consumption in the global markets there. Also, the Chinese demand is something that the OPEC is putting a lot of hope on. And as far as the OPEC and the non-OPEC output for 2023 is expected, that is expected to be on a flatter note, actually lesser for non-OPEC. And in the second half of this year, that could perhaps be the reason that you could see support coming back in case of the crude oil prices.
All right, Manisha, thanks a lot for getting us that quick update. Crude currently below the $85 a barrel mark, but we are going to get into a short break now. When we come back, we have another corporate conversation lined up for you. We will speak to the management of HEG to discuss the company's Q3 earnings. Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18. The market has picked up a little bit, so we're around 20 points in the green right now. The banks also have moved into the green right now, so it's a 35-point gain that we are seeing on the Nifty bank. And of course, the mid-cap index continues to outperform. It's almost 100 points higher over there, so that one looking quite strong. We'll talk more about the markets, but for now, let's get another corporate conversation going. HEG reported a weak set of third quarter earnings. Utilization levels this time appear to be quite low, so we'll talk more about that. The margin has also come under pressure. Just to alert our viewers, the stock has been under pressure. You know, it's down around 9% in the last 1 month or so. The street was sensing a bit of a subdued quarter because of, commentary that came through earlier from other companies in this space. So to discuss, we're now joined by Manish Gulati, who's Executive Director at HEG, to take some questions. Mr. Gulati, thank you very much for joining us. I'm Pavitra. And, if we can just begin by talking about the utilization levels, because like I was mentioning, it does appear to be quite low. Can you take us through what the level is like for the quarter gone by for Q3?
Yeah, good morning. See, the capacity utilization for Q3 is in early 60s. And of course, as you rightly said, the volumes came under pressure, but that's because of the global event ongoing of this Russia-Ukraine war. The steel production year on year has been seen a 7% decline. But thankfully, we have been able to maintain or protect our margins, although the top line is down, as you rightly said.
Any pushback, sir, from orders? Last time you had highlighted the weakness in the European geography particularly. Are you getting any order cancellations or pushback or delays?
See, the pushback mainly happened after the Q1. It started to happen, then Q2 and Q3. And now it has, the demand has normalized. Some inventories, excess which they had, have been corrected. And whatever the real demand is coming globally is what is now shown up in our sales.
Okay. So then why is your revenue down 11%? If the demand has normalized, your revenues are down 11% year on year and on a quarter-on-quarter basis, sir.
Yeah. See, I'm expecting this Q4 volumes to be better than Q3. I think the Q3 volumes were the worst with all these corrections, and Q4 onwards, I'm expecting better volumes.
So you're expecting better volumes in Q4, Mr. Gulati. What are your current utilization rates? And I believe you also delayed your expansion plans by a couple of months. Can you give us some update on that? Just trying to get a sense of when you really think the business will bounce back and those utilization levels will pick up.
See, in this Q3, we are in early 60s. In the past quarter, Q2, we were in early 70s, and past Q1 was actually in early 90s. So gradually, our capacity utilization has come down, aligning our volumes with the demand. Going forward, Q4, I think that the volumes will be better than Q3, and we are looking forward for these global events to get corrected and maybe the normal demand to return maybe after another 2-3 quarters.
And okay, so what about the inventory position right now? How much inventory are you sitting on? Some sort of indications there?
I mean, normally in our industry, we work with 1 month of working inventory, which is very, very normal. So it's now, let's say, close to 2 months. But that is really doesn't matter because we are awaiting the moment the demand comes back, we'll be able to liquidate it very fast. And in any case, we had a sufficient amount of our raw material inventories.
Okay, Mr. Gulati, just one quick question on the volumes once more. I think earlier you had indicated that would be for the full year it would be down around 5 to 10%. If you're saying Q4 is likely to pick up so much, is that still the level that you expect, or do you think it would be a little bit better than that?
No, as we total through the year, it'll still be down compared to the last year. The last year volumes were very good, and maybe a little more than 10% if we total for all the quarters. See, what I want to mention one thing here, that we are looking, when we look, we don't look quarter by quarter as such. We are very upbeat and highly positive about our industry. See, there was a demand, I have been mentioning that a few times in these interactions, that there's about 20 million metric tons coming in US, there's about 16 million metric tons capacity switch happening from blast furnace to electric arc furnace. And we are happy to see that what we have been saying in past few quarters, one of the big industry players also said very recently that they are expecting the demand to go up by 200,000 tons. So we are very positive about our industry. The decarbonization which is happening is taking steam very fast. It is changing faster than we realize. It is just about this global event of Russia-Ukraine war getting out of the way, and the normal trajectory of electric arc furnace steel will resume, and thus will be the demand. And HEG has been the only company in the Western world expanding. And you mentioned about the expansion getting delayed. Yes, that's absolutely correct. We mentioned that in our results. There have been delays in arrivals of some of the equipments from mainly European suppliers, which is now on the way, and some of them have reached. So we are kind of running 3 months late. But really, it doesn't affect as much, although we preferred we would have come on time, because the market is also at presently, we're not running at 100%. So the 3 months delay really doesn't impact us as much as it would have.
Okay, just getting back to that point about demand picking up, how much better would Q4 volumes be compared to Q3? Any rough indication? And what could your capacity utilization improve to from the current early 60s?
Yeah, I'm expecting the Q4 volumes to improve from early 60% level to 70%. That's I'm very sure of, because we're already in the middle of February. So I can see what is happening. So it should go back to 70% for Q4.
Okay, just a word on your expansion plans. Can you tell us how much capex you have lined up and whether there's a delay in timelines? Because Nigel was telling us that I think you have now shifted it to about April of this year, 23. The earlier deadline, the earlier timeline was December of 22. So are you still going to take this expansion in by April, or will you push it down a couple of months till the inventory position clears up and the market picks up?
No, we are nearing completion actually. So if there are 5 processes, 4 shops have already started. So it will definitely come in April. The total outlay has been 1,200 crores for this expansion, and we are very much sticking to that. So there's no delay because of anything, because more than half of the plant has already started actually. So just one odd process awaiting the start.
You did indicate there was a delay in arrival of some equipment from overseas suppliers, particularly Europe, because of which you had to push the completion of your expansion plan. But thank you very much, Mr. Gulati, for joining in. Q3 appears to be the worst for HEG. Things are improving. Q4 volumes to be better compared to Q3, and utilization will pick up. And the capacity expansion is on stream. It's on track, but it's just delayed by 3 months. Get into a break. We'll discuss technicals with Mitesh Thakkar. Welcome back. Markets ticking up, now approaching that 17,950 mark on the Nifty. This is where the 100-day moving average lies. The 100-day moving average on the Nifty is 17,947. So we're exactly at that 100-day moving average. Let's see whether we can conquer that. FMCG is on the back foot today. The Nifty FMCG index is down 1%, with heavies like ITC, HUL, Britannia on the big losers list. But let's talk about the way forward. Mitesh Thakaram, earningswave.com, is with us on the show now. Mitesh, morning. Thoughts on the day so far? What stands out for you and the trade that you would recommend?
Good morning, Reema. It's been a good day. We had a negative opening and then we have recovered nicely from there. But as you were highlighting, the 17,950, there's the 100-day average, and then 17,975, which was the highs which the Nifty made on the 1st of February. I think these are two important pivots. I think once we cross 17,980, I think I'll be more comfortable adding on to longs on the index side. But till then, we've been trading with more of long biases yesterday on the stock specific side, and I think today, auto names have given a good breakout. So I'll have a buy on Maruti. Keep a stop below 8,800. Look for targets from 90.50 on the upside. And the other one, which is reversing after a good correction, is Eicher Motors. Eicher Motors is a buy as well. Keep a stop below 32.90 here and a target of 34.25 on the upside can be looked at.
Okay, Mitesh, got that. Thanks very much for giving us the calls. That's, of course, the market as of now. Let's look at some of the stocks. And we're talking about packaging companies because a lot of them have come under pressure. Look at what's happening to a Uflex or an Ester Industries. I mean, cuts between 3, 4, 5, 11% on Ester, actually. So lots of pressure. What's going on? Let's go across to Sonal with what seems to be bothering this entire space as a whole. Sonal?
Thanks a lot for that. Well, what happened in Q3 is a lot of supply that came in the packaging industry, and it reduced or made these spreads to come under pressure as well. And that's exactly what's seen in Q3 numbers across packaging companies as well. Let me start with Uflex, where it was a big loss that the company reported, and it was a surprise as well. So the revenues were flat at 3482 crore rupees. EBITDA was down 57%, leading to a margin compression of 1,000 basis points. And the company reported a loss this time around at 85 crore rupees versus profits of 300 crore rupees. They say that loss is due to currency devaluation that was seen by Egypt, and national foreign exchange losses due to currency fluctuations and devaluations were totaling to 236 crore rupees in this quarter itself. Additionally, the supply side issues continue to impact the company's margins. Ester Industries, a big fall in stock price today, revenues down 31%. The company has reported an EBITDA loss of 1.5 crore rupees and loss of 8.8 crore rupees. This compares with profits that the company reported in the year gone by. The EBIT loss was led by their polyester chips business, where it was a loss of 2 crore rupees versus EBIT of 40 crore rupees. Specialty polymers also saw a sharp decline in EBIT on a YOY basis. Cosmo first, another weak set. Revenues declined 5%, EBITDA is down 57%, margins at 8.7% versus 19.2%. Profits also down 56%. The company says that yes, there was excess supply which led to lower spreads. Demand also in some of the economies were lower, especially in the overseas markets. Contribution margin dropped below the sustainable levels for the industry overall. There was a one-time inventory loss because of raw material prices as well. And all these reasons is something which led to margin decline across the industry players.
All right, Sonal, thanks a lot for taking us through all of the earnings that came through from, these packaging companies that you were just talking about. We are going to get into a short break now, but on the other side, we'll get you a chat on the markets. We'll be joined by Devang Mehta of Centrum Wealth Management, so stay tuned for that conversation.
Welcome back. We are in conversation now with Devang Mehta, Head of Equity Advisory at Centrum Wealth Management. Devang, thanks for joining in. Very quiet day today for the market. Not much is moving. It's been actually a quiet start to the year, at least at the index level. But, we were just looking at our conversation back, I think it was in December sometime, where you were talking about themes for 2023. And I wanted to pick up on one of them where you said discretionary consumption. This is always an interesting one. How have you started sort of maneuvering in the portfolio to play on this theme? Are you looking for consumer technology companies? Are you looking for FMCG? What part of the consumer do you want to bank on?
Thanks for having me on the show, Surbi. I think, yes, very clearly you got it right that we mentioned that as one of the theme. And why we are playing that as one of the theme is clearly, if I can again, at the expense of being repetitive, I can say we generally like the 4 C's of the market. And the first C is clearly consumption, which India has always been on a strong footing, be it discretionary, be it non-discretionary. And particularly at this point, your luxury and discretionary consumption at the upper end is surely thriving. be it pent-up demand being converted to structural demand. So one is this consumption. The second is capex, which is necessarily coming from the government as well as the private sector. Credit growth again from the economy, from the banking sector, around 18%, which again boosts consumption and capex. It's a chicken and egg, right? So both of them are thriving on even credit growth. And last but not the least is corporate profitability, which I think we are coming to the fag end of this the third quarter number season, where we have seen generally for discretionary consumption, coming back to the question, is more or less we have seen some of the companies like Titan again, which has been a favorite and been a rock steady stock during this entire rocking boat over the last 2-3 months. We have seen so many events, but most of the companies which came up with numbers were sort of, at least if not enthused by the exact numbers, the commentary was sort of bullish, or commentary was rather more on the front foot. Also, one thing which we are seeing is raw material cost for a lot of these companies had an impact earlier. That seemed to be probably waning away. Yes, we are again seeing certain metal prices probably thriving, but most of the raw material or input cost pressure, be it consumer discretionary, be it even you can probably count something in building materials, so home improvement as consumer discretionary. We have seen great corrections in some of these businesses like Asian Paints or Pidilite, certain, just mentioning few of them. I think most of these companies are probably bound to come back as soon as the FII flows resume, or as soon as the market gets into a sort of a little bit of a bullish territory, if not completely bullish.
There was one argument which was made on Titan. They're saying that the competitive intensity is picking up because many of these regional players, the large regional players like Kalyan, Malabar, they're now aggressively expanding their storefront in their non-core markets in the franchisee format, or even going via their own stores. So they're saying the competition for Titan is only going to pick up because these companies like Kalyan and Malabar are now looking to expand beyond their core areas. So we'll be watching that. Devang, what about insurance, right? In the month of January, insurance was making a comeback, but then came the budget and there was a slam dunk. Since then, the stocks have recovered, but they haven't gone back to their pre-budget levels. Thoughts on insurance?
Yeah, I think this is one sector which we started to sort of like 1.5 year back. I think post COVID subsided. We knew that most of these companies had huge claims, be it HDFC Life on the life insurance front, or even ICICI Lombard to be specific on even general insurance front. Most of these companies were sort of marred by the claims. But what we saw in the budget is, of course, two things. One, very important thing was sort of that 5 lakh limit, where probably your taxable post that type of a premium, which again impacts the HNI segment or the ultra HNI segment, who probably sought insurance as one insurance, and second as even a tax arbitrage or an investment tool. That part goes away, which impacts some of these companies. And we were on call with few of these companies and listening to a lot of commentary. I think most of the companies are categorical, saying that this will not have a material impact, maybe a 5-7% impact on the profit pool, which I think there will be a lot of product or a lot of structuring around it where they would not let it go away. So my sense is that the reaction right now is a little more, I can say, circumstantial in a way. The second part is when you opt for the new regime or the second regime where investments are not compulsory. So the new age Indian or the youngsters in India probably would not invest much. They would probably use it as a consumption tool. So that also is I can say, a negative sentiment impact for insurance businesses as such. Yes, that probably the valuations had risen from there. It has come down for probably HDFC Life or SBI Life less than around 2 times or 2.5 times price limited book value. Stocks look interesting. Yes, it would probably go through that sentiment change for the next 3-6 months where people will just sort of ignore it. But my sense is there is value available over here.
Speaking of insurance, take a look at the GIC stock. It's just completely rocketed away, 8.5% up on GIC. Quite a mover. Of course, that's a reinsurer that we're talking about. But that is the conversation on insurance. Before we let you go, Devang, you've named a lot of companies. Most of them are large caps or very large mid caps. Are you looking at anything in the tier 2 category? Any of the smaller companies, and if so, then what are you picking and choosing?
One sector which I can't sort of forget is capital goods or ancillaries in the capital goods space, or something like an automation or a tech AI businesses stuff. I think this as a space is sort of developing, and over here we find a lot of alpha generating candidates, something like a Hitachi Energy, which has been a favorite. Of course, the company didn't report great set of numbers, but over the next 3-4 years, somebody wanting to get into a wealth creation journey, again saying not recommending, but most of these businesses we hold in our client portfolio. So So something like a Hitachi Energy, something like a L&T Technology Services, again, a company which sort of has collapsed in terms of valuation. But the numbers have been encouraging, the commentary has been encouraging. It's into AI sort of robotic sort of space. Honeywell Automation, another company which we sort of like if somebody wants to invest in classy businesses rather than getting into stuff which will be turnaround. These are companies which would benefit from India INC doing a lot of capex. My sense is these 2-3 ideas are where we probably would bet more for the next couple of years.
All right, Devang, we leave it at that today. Lovely to chat with you as always, but we are going to get into a short break now. You don't go anywhere. There's lots more market action coming up for you in just a bit. Hey guys, welcome back. You're still tuned into Trading Hour. The Nifty Bank, by the way, is back in the red. So it's around a 30-point cut that we are seeing on the Nifty Bank. The mid-caps also, in fact, have come off a little bit. So the index, it is still outperforming, but it's right now just around a 0.2% gain that we are seeing there. But let's now get you a quick update on the Srei Group resolution process. CNBC-TV18 has learned that most of the group's lenders favor the NARCL's resolution plan. So Ritu joins us with the details now. Hi, Ritu. What are you picking up?
Well, Pavitra, the voting on the Srei twins ended late last night after 11:30 p.m. So while the final tally is still awaited because of some calculations that are still ongoing, we have been given to understand from multiple sources that a majority of the lenders have selected NARCL, or the National Asset Reconstruction Company, as the winning bidder. And that is the application that is likely to be forwarded to the RBI and subsequently to the NCLT for its final note. Remember, we'd been reporting earlier that NARCL's offer stands at 5,555 crores in net present value terms. It was closely followed by Autumn Investment, which made an offer of 5,526 crore rupees, and Verde and Arena's bid was the lowest and is likely to have secured the least number of votes from the lenders. Now, while this voting and this is ongoing, and the Committee of Creditors will be meeting today to take on record the results of the voting and proceed to file the application with the RBI, we've been given to understand that as of last night, the Canorias, which is the promoter of the Srei Group companies, have filed an application with the NCLT against lenders' decision to not consider their settlement offer. If you recall, we had reported that they had offered to fully repay all of the lenders by monetizing assets, by converting some of the debt to equity, and by bringing in capital from an unknown investor. But given the fact that the reason why the company was superseded in the first place was because of governance concerns and defaults, it is unlikely that it would qualify under 29A, and therefore lenders did not consider that proposal. Now that could pose a legal hurdle, but as of now the plan is to proceed with the filing of the application with the NCLT before the deadline ends on the 18th of Feb.
Ritu, thank you very much for those details. Out of time on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime Report is up next.